Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Been a while, but I'm back with another investing video. Going to take a look at ViacomCBS. Just released their earnings, down about 22% after their earnings, which don't seem that terrible, but the market obviously disagrees. More of a focus on streaming here. They're changing their name. As always, guys, this video is just for fun. I am not a qualified financial advisor. Please make sure to do your due diligence before investing in anything. So let's take a look at ViacomCBS, soon to be known as Paramount, down 22% today. This is a stock that was at $101 after a little bit of a short squeeze during that whole Bill Huang debacle or whatever his name was, where some funds actually went under owning some of these stocks as they fell quite a bit. This is a shorted company, a company that's had some ups and downs, traded down all the way to $13 during the height of the pandemic when everything was disgustingly cheap, ran back up into the 40s, obviously into the 100s here, stuck around into the 40s, fell back down to this range, went up before earnings, and is now back to $28. So what does that mean? The 23.4 billion market cap, down about 22%, down to about an 18.2 billion market cap on a company that's getting almost $30 billion in earnings, has a streaming service. They do have some debt. If you add the debt in after some of their cash disposals, after some of their disposals that helped cash, you're talking about a 29 billion enterprise value company after this fall, something around there, but we'll take a closer look at that. If you look at their earnings today, clearly they have a long-term outlook that is very focused on streaming going forward. You look at this earnings deck they released, the earnings presentation by their chief financial officer, really, hey, we are a streaming company. Global streaming subscribers are up 9 million quarter over quarter to 56.1 million. Pretty good, actually. Global Pluto TV MAUs. Pluto TV is their free streaming service, up 10 million monthly average users from 54.4 million to 64.4 million. This is fully an advertising-based business. This is a advertising plus subscription-based business. You can get Paramount Plus. You can get Showtime. I am not subscribed to either of those. I do get Showtime through my father-in-law's TV subscription, so I watched a show here and there. I've watched some movies on Pluto TV, so it is something that I've used before. I am probably one of these monthly average users, but again, maybe it's a movie here and there. Content-wise, not too amazing, but it's free. It does have commercials, which are annoying, but it is free. So their global streaming revenue, quarter over quarter, up almost 50% to 1.3 billion. This is now a pretty decent sized streaming business. You're talking about something that garnered 4 billion in 2021. If you're looking at this as an annual run rate going forward, probably increasing, that's 5 billion plus 5.2 billion on an annual run rate in terms of streaming. If you look at the multiple that the market gives something like Netflix, and now obviously Paramount Plus and Showtime are nowhere near Netflix in terms of quality of content, quantity of content, yet the amount of money Netflix spends on content far eclipses these guys. Well, maybe not far, but in terms of TV rights, in terms of shows, obviously CBS pays quite a bit for stuff like the NFL. So that multiple is somewhere in the 6 to 7 range in terms of enterprise value over revenue. Now, I'm not going to give a 6 to 7x multiple to Paramount Plus and Showtime, but as those improve, as this number goes up, as this growth potentially continues, you can make sense of a 3, 4, 5x multiple. So if you're talking about a 5x multiple on basically 5 billion in forward revenue, right there you're at 25 billion just for the streaming business alone. Now that's probably a bit optimistic. If I have the multiple against 5 billion, 15 billion in terms of their enterprise value. So 15 billion against the 29 billion total business just for their streaming starts seeming like an interesting deal here. Now that all depends on this streaming business being profitable on a go-forward basis. It's not going to be, at least probably until 24 or 25, so you're years away from this being profitable. They're spending a lot of money on content. They're probably reducing their cash flow to almost flat on a go-forward basis simply because they have to put more money into content. They're going to reduce the amount of money they get from affiliate fees because they're lending out, hey, South Park to HBO Max and getting a couple $100 million for that. That is a mistake that they've made. South Park is on HBO Max. Emily in Paris is on Netflix. What other stuff? Station 11 is on HBO Max. Great show. All of these are Paramount shows, Paramount produced shows that they send to other networks to make their streaming services better. And yet they are now focusing on Paramount Plus and seeing that, hey, if we just kept those shows, hey, freaking, what's that show with Kevin Costner, whose name I can't remember now, that is a big hit on Peacock, big hit everywhere. It's a Western. Let me Google it. Yellowstone, another show that they basically said, hey, here's one of the most popular shows that are out there right now. Take it, Peacock. Give us some money, where they could have had a lot more in terms of subscribers and a lot more in terms of revenue because they had all of those marquee shows that they rented out, basically. So that's the annoying thing if you're looking at Viacom. If you're looking at their history, this has been a mismanaged business. They've done poorly in a lot of areas, and those are just examples of that. They've just they just suck. If you look at the CEO, if you look at Sherry Redstone, who basically owns CBS, Viacom, going forward known Paramount, this is crappy leadership across the board. This is why the market looks at this company and gives them such a low multiple in relation to the earnings power that they have, because they don't believe that they can achieve a lot of things. Now, if you disagree with that, this could be potentially a good value at today's prices, and that's kind of why I'm looking at this. Do I feel like they can make the transition to a streaming powerhouse? Well, right now they seem to be doing that pretty decently, but who knows what's going to happen going forward. If you look at their non-streaming business, which has grown quite quickly, this is where this business lies. It's a very slow growth, even keel business where, hey, they have a decent amount of advertising revenue. It's not really growing. They have a decent amount of affiliate revenue. It's not really growing, but they have done a good job of reducing this. If I look at this number here, right before this quarter, their debt was basically plus 14 billion. Now it's down to plus 11 billion, which is helping their enterprise value, helping this be a more reasonable valuation. It's still a problem because you're looking at a net debt position of 11 billion against a market cap of 18 billion. So not amazing, but this is a strong EBITDA business, even with the investments they're making in streaming, and they can readily handle this debt load. They do have a pretty strong cash position. They have sold off some assets in the last couple of quarters that some were earning them money, some weren't. They sold some real estate, so now they're renting that real estate instead of owning it. They also sold Simon & Schuster, which was their publishing arm. Not sure that was the best bet, but they wanted more cash to invest in streaming. So you can kind of look at that as a good thing, obviously going to help streaming growth. But this is a business that was generating cash, that was generating EBITDA, and they sold it to invest in something that's going to be a cash burn for a couple of years. So clearly a change in their priorities. Whether the market will reward that, that's the big question as an investor. Right now, the market is looking at these streaming services with a more granular view. A couple of years ago, streaming was all the rage, but now people are saying, are these companies ever going to actually make money? Now, Netflix is starting to be cash flow positive, but it's still a very small amount of cash flow. With the competition out there, it's going to get tougher and tougher. Is Paramount going to be able to do well against Netflix, against Peacock, which sucks, against Apple TV Plus, which is actually pretty good, against HBO Max, which is the best streaming service in my opinion? These guys have Showtime, they have Paramount Plus. Will they ever combine that? I think that Paramount Plus Showtime could be a pretty decent powerhouse, but right now it's a split. So that is kind of annoying. Right now, a lot of good Paramount shows are not on Paramount Plus, so that's kind of annoying. But they still do have a lot of decent IP, a lot of good content that they can use to grow that streaming service. For example, Halo, a TV show based on a video game, is coming up. Potentially something that I will subscribe for. Just one show is going to make me subscribe for a month or two, watch the show, catch up on all the other stuff, and see if I like the content. I do think they have the potential to become a streaming powerhouse. They are the fastest growing streaming service. But again, they are starting at a much smaller spot, and some of these other names are already established. I do think Paramount Plus and Peacock are sort of in that same spot where they're not the best of breed. They are sort of the runts of the litter. They need to make their content better in order to continue growing and catch up to Netflix. And I think even though HBO Max has a lot of amazing content out there, their growth hasn't been as amazing as some of these other players. So interesting play here. I do think this is going to become a Paramount Plus play in the long run. If you believe in Paramount Plus, if you believe in their commitment to this streaming service, then this is a price point that's very interesting. Like I said, this business is probably on its own right now worth anywhere between 10 to 15 billion on a enterprise value basis based on the multiples some of these other streaming companies are getting, even cut in half. But it's a question mark whether that multiple will be given to these companies in the future as they struggle to maintain and produce cash flow, because the investment required to have these streaming services be competitive is very high, and it's tough to see when they're going to be actually cash flow positive here. So Pluto TV is another little thing that they bought for $1 billion a couple of years ago. A great move in my opinion. This is one of the few moves that these guys made that was really interesting. And now this is a $1 billion plus business, revenue business, growing really well. The average revenue per user here isn't amazing, but there's a lot of users. It is an advertising based business. You're talking about $2 per user. Not a huge amount, but that number is growing. Bunch of segments that they're splitting out to TV media, film, entertainment, direct to consumer, which is their streaming. And this is the interesting part about ViacomCBS. They do have a decent amount of brands that are decently solid, right? CBS is a well-known brand. They have the NFL. They're just signed a contract to retain the NFL until 2033 rather. You know, Nickelodeon, Showtime, MTV, Nickelodeon again, Paramount Plus, Pluto TV, decent brands, decent IP, not amazing. If I'm talking about IP, if I'm talking about brands, you know, HBO is better, Netflix is better, potentially Peacock is better. They're not amazing, but they are putting money into some of this IP, developing new shows, Halo, etc. You can see that this is a very competitive landscape. Amazon's out there producing, you know, a new Lord of the Rings show, which looks kind of iffy. Wheel of Time, which is a book series that I love, and the show was kind of iffy, but a lot of this stuff is enjoyable. You know, you can pay $9 a month or whatever and get a lot of entertainment for that fee. So I do think streaming is here to stay. It's just a matter of, can all of these services exist on their own, or will there be some combinations in the future? You know, does Comcast combine with Viacom, CBS, Paramount a couple of years down the line to make Peacock, Paramount Plus a service that's actually competitive with some of these other players that are already well established, whether it's Disney Plus, which I haven't mentioned, tons of subscribers, tons of good content, tons of good IP, Netflix, tons and tons of content. A lot of it sucks these days, but still a lot of it is pretty good. And some of it is produced by Paramount for some reason. HBO, highest quality content you get out there, decent stuff all across the board, you know, some turds here and there, but overall really good. And then Apple TV Plus, which I think is, you know, a small player in the space, but their content is solid, really solid. You know, some of my favorite TV shows were from there. If I look at Paramount Plus, if I look at Showtime, is there anything out there that really interests me? And again, I'm just one person. This isn't speaking for everybody out there. You know, Halo interests me. I watched Dexter New Blood, which is okay. Is there anything else out there on those networks that is great for me? You know, Star Trek is okay. Not really a huge Star Trek fan. I've heard some of those shows are iffy, but if you're a Star Trek fan, you probably subscribe to Paramount Plus. They have that IP, which they can really develop into a lot of content across the years, and certainly a lot more stuff. South Park is on there. Again, the series itself is on HBO Max for some reason, but by, I think, 2024, 2025, they plan to bring that back to grow this streaming service. Now, is the trade-off worth it, right? They're getting $500 million from HBO Max for that content. If they bring it back to Paramount Plus, will they be able to get $500 million in revenue for that? And the interesting thing about, you know, CBS as opposed to Netflix is they sort of have a flywheel of content that is already being produced anyway, because they have TV media, they're producing stuff for CBS, right? So that money's already spent, but they can put that stuff onto Paramount Plus and earn even more money than they would just by airing it on CBS. So that's the interesting thing, right? They have this sort of circular content wheel where they're earning more money than they would if they just put it on streaming. They're not just getting the money from streaming, they're also getting the money from the advertising and TV media and potentially some affiliate deals that they have with other companies. So different business model, a bit more complicated than Netflix, where they just, hey, we have subscription services and that's it. Potentially this is a better business model, right? Because they can put Young Sheldon or whatever crap is on CBS these days, earn money via advertising there, and then eventually put it on Paramount Plus. And if someone's a fan of Young Sheldon, they'll subscribe and watch it there and pay $9.99 a month or however much that costs, and earn more money that way. So that's the interesting part. They already have a highly profitable TV media segment, earns a ton of money and adjusted operating income before depreciation, etc. And they can use that money to pump even more content, not only into CBS, but also into Paramount Plus. That's kind of what I like about this. They have this high growth direct-to-consumer segment, which has grown 83% year over year, but is burning cash. So you've got one that's producing cash and another one that's burning cash. That's sort of the spot you want to be in if you want to grow streaming, because you're not burning cash right away. You're not having to issue stock to do that. You're not having to borrow money to do that. They are in a spot where they can produce more content and also pay down their debt because they have this TV media segment that produces a lot of actual profit. Subscribers are growing. If you look quarter over quarter for Paramount Plus, they have 21 million additions in 2021. A ton of growth year over year. That's probably surprising. It's certainly surprising to me. That's why I'm looking at this stock. I kind of thought Paramount Plus is an afterthought. But hey, they're up to 33 million global subscribers. Pretty solid. They have this Pluto TV business that has 60 million plus monthly average users. Pretty solid and growing. If you believe they can contain this and continue this growth pattern, could be a very good investment at this price. If you believe that somebody down the line will come a-knocking and say, hey guys, we know you have a pretty decent amount of content. Content is expensive these days. MGM just got bought out for $8.3 million, and they certainly don't have as much revenue as these guys. They don't have these, this TV media business. I feel like the content is comparable. Those guys have Bond, but you can't really do anything with Bond because it's owned by some family. These guys have a decent amount of content. So at the very least, if the streaming business is worth 10 to 15 billion, this at least content business is worth, $8+ billion minimum. And then they have this TV media business that's just, producing a decent amount of EBITDA. You have to give that some sort of multiple, and you're very quickly getting to this 29 billion range without any sort of crazy assumptions, without assuming any amazing growth in the future. Paramount Plus is still a relatively small business, 1.3 billion in revenue, but then you add to that the Pluto TV streaming, you add to that Showtime, etc., and you're getting to a streaming run rate of almost 5 billion in 2022 without any growth built in. $9 paid average revenue per user, pretty good. You've got domestic drivers in 2022, trial to pay conversions with ad monetization. They do have an ad supported subscription with lower prices and one that's without ads. If I ever subscribe to this, I'm definitely going to the one without ads. And if I buy the stock, I might just subscribe for fun because, hey, have my $9 and then the dividend will pay for it. Why not? Western European market launches are coming in 2022. Then they have strong Pluto TV growth. If that continues into 2022, pretty solid. Domestic and global average revenue per user growth is pretty good. Again, they can probably charge more money for advertising as they have more and more eyeballs, which is why this is driving what's driving this growth. And then you've got content expense, right? They're increasing that in 2021. You're probably going to see more of that into 2022. But again, some of it is intercompany licensing. If they have content that they already produced for CBS, it's no additional cost to them really to move that content onto Paramount Plus. The only additional cost is that they potentially lose out on some affiliate dollars that they could gain by sending it to HBO Max or sending it to Netflix or whatever. So there's a lot of content out there that you don't think is Paramount. Let's say, who knew that Emily in Paris is actually owned by these guys? I certainly didn't. Very popular show. I watched it. It was delightful. There is a streaming market opportunity. Again, like I said in the beginning, this is clearly becoming a streaming play. This is what they're aiming for. They're renaming their whole company Paramount. Their streaming service is Paramount Plus. They're saying we're going all in on this. We do have a theatrical box office. We do have linear TV, sure. But a lot of that is going to drive value into Paramount Plus. And you're kind of seeing this in this flywheel that I talked about. You've got, hey, we make content for CBS already. We make content for Nickelodeon already. We make content for the box office already. Then we can put that content onto linear TV because we own some channels. We can sell it via Amazon or whatever if you want to download to own or rent. We can put that onto Pluto TV, no additional cost to us. We can produce consumer products out of that, no real additional cost to us because we already own the IP. And then eventually we can put it on Paramount Plus, no real additional cost to us besides the amount we're foregoing by selling it to other companies. And that lifetime value of that content they produce is worth a lot more than it would be if they didn't have this entire business line that floats all the way down to the streaming that is a monthly recurring subscription. So they can, spend $120 million on a Sonic movie, earn some money on the box office, earn some money from, rentals and purchases, and then eventually put that on Pluto TV, eventually put that on Paramount Plus, and earn even more money. They can produce content directly for Paramount Plus, which obviously costs additional money, but they can also produce content directly for linear TV, whether it's CBS, Nickelodeon, etc. Eventually some of that goes to Pluto TV, eventually some of that goes to Paramount Plus, and the amount of money that they make from each dollar spent on content is suddenly worth a lot more today than it was 5 years ago when they didn't have Paramount Plus, when they didn't have Pluto TV. So all of this additional stuff certainly may be a negative on returns in the first couple of years because they're suddenly increasing the amount they spent on content because they want to get Paramount Plus growing and running. But sometime down the line, it should be a relatively interesting business model, especially once Paramount Plus kind of eclipses that maybe 100 million global subscriber mark and starts actually not being a massive cash burn. Again, strong content IRI that you can kind of see where some of this content's going. And they're also raising long-term goals with this, right? This is another example of why this is becoming a direct-to-consumer play. They're putting less focus on their TV business, their advertising-based business, their affiliate business, which can be a good thing, can be a bad thing. The market is kind of reevaluating some of these streaming companies already. Netflix isn't where it used to be. This is a growth story, and growth stories aren't really that popular anymore, which is potentially why this 22% decrease is being shown, despite the fact that, hey, we were kind of projecting 65 to 75 million streaming subscribers by 24. Well, we're already at 56 million in 21, we being Viacom. Now we're saying we're going to be 100 million plus by 24. And if they can hit that, if this business can become self-sustaining in a way where a lot of that content that's being produced for Paramount Plus directly is being covered by the revenue that's coming in from these direct-to-consumer products, then this becomes a really interesting play because you still have that ad-based, that linear TV business that's probably still going to be earning money, pretty decent money. It's not going to grow very quick, but it's going to produce cash, and they can reinvest that cash into additional content. And once they have a library of content, we're suddenly sitting in a pretty good spot if you're an investor of this company, which I am not yet, but I'm starting to consider it. Again, Pluto TV, monthly average users, new goal is really 100 million plus, growing average revenue per user, etc. And you're talking about revenue that's direct to consumer that's into that 9 billion plus range by 2024. So you're talking about 9 billion by 2024. If you're given that a 3 to 4x multiple, by 2024, you're basically covering the entire enterprise value of this company just with direct to consumer revenue. Again, that's 3 to 4x multiple. Whether or not that's what the market's going to give these companies by then, who knows? We'll have a better example of something like this when Warner and Discovery merge together. If you sort of look at Discovery, certainly not a streaming company by any means, but it's relatively similar, getting a 3x multiple. And what's Viacom getting in terms of their revenue right now? Basically a 1x multiple. So where's the where's the difference here? Is ViacomCBS worse than Discovery? I don't think so. They have a better streaming service in my mind. I like Discovery Plus, but you know, I think these guys are going to be able to grow faster, and actually, if they can hit this 9 billion revenue, then you're sitting in a pretty decent spot from a streaming revenue point. But you also have all these other businesses, whether it's affiliate, whether it's advertising, what have you. Interesting business model here. All of this focuses on streaming here, but obviously we can go to the other actual release and sort of look at, well, where's the other business here? Well, the majority of the business is in advertising, right? They have this linear TV model that really presents an opportunity to generate cash that they can be invested into streaming. You have this affiliate model that can be invested into streaming. You have this licensing model that can be invested into streaming. Now the question mark becomes, how much of this is going to be at the behest of licensing and affiliate, right? Are they going to license less stuff to other carriers because their streaming is becoming more and more of a focus? This is probably a lesser margin business than this. You don't really have to do much with licensing. It's quite easy money, but again, potentially they can make more money in the long run from having their own streaming service. So this is clearly the story that they're trying to talk about. The growth is here. You're talking about 4.1 billion in streaming revenue, 1.3 billion in the 3 months ended 30/31 because of all that growth. So you're talking about 5-ish billion in 2022 probably in terms of streaming. There's going to be growth here. The question is, how is this going to impact some of this stuff, right? On a non-GAAP basis, their EPS is down 17%. If you look at some of this other stuff, yeah, streaming revenue is good, but it's essentially a negative margin business right now for you, and you're investing a lot into it. Is it going to pay off? The market seems to think that potentially not, because they don't like this story right now. But I sort of do. If I look at the stock as a whole, this is a business that's already making money. This is a business that's going to produce, anywhere from 1 to 2 billion in free cash flow any given year. If we go back and look at some of these estimates and what they had in the past, you're talking about 1 to 2 billion in free cash flow. This year it's a bit lower, maybe 1 to 2 billion going forward, despite all of the investments in content. If they can do that, that's a what? 1 billion against a 30 billion enterprise value. 3.3% free cash flow, despite investing into content and potentially growing at a faster clip if that pays off. It's an interesting investment in my mind. You get this free cash flow. It's paying a dividend while you sort of wait for it, and you see if the story plays out. It's not a huge risk investment because this is a profitable business that's going to pay you a dividend. I don't think the market's going to price it far lower than it is now on a long-term basis. Obviously, in the short term, if Russia invades the Ukraine, or if rates suddenly go up 50 basis points and then 50 basis points again and then 50 basis points again before the year is over because the inflation is running away, any stock can go down far lower than it is today. But at this price point, you're getting almost a 3.5% dividend. You're getting a growing business, even if it's growing slowly. And you're getting the story of a streaming business that's emerging and growing at a much faster clip than people probably expected. So despite the reaction of the market, which I think is driven by some of these EPS issues and some of the pressure on profits that the streaming investments will put, I think this is the right move from their perspective, because again, they're not giving up on the linear TV model. That's still going to be around. And I think it's still going to grow at a small clip or may potentially shrink at a slow clip. But if you're getting, $6 billion in linear TV or content investment, even before streaming comes in, and that $6 billion a quarter produces, probably close to $1 billion in EBITDA a quarter before that is squandered away on content. That's an interesting business right there. And then you have this upside of streaming potentially becoming a bigger piece of the puzzle, and by 24, by 25, becoming actually cash flow positive. Now, the concern is that, hey, streaming slows down and some of this other stuff doesn't really grow at all. So why give this a higher multiple than it's getting today? And if this is growing at 5%, then maybe that's the return you're going to get. And that's a problem when you're expecting something like 10% plus from the market. However, if you look at the market today, even after the recent fall, it's still relatively overpriced. And if I'm looking for investments in this type of condition, there's certain growth stocks that are certainly looking interesting, but I also look towards value because value is a bit safer when market conditions get iffy. Now, Viacom could certainly drop to $15 in a couple of months if markets get even worse than they are today. But if that happens, then I'll get a 3.5% dividend, and I don't think this is a business that's going to be destroyed in an economic downturn simply because people are still going to watch TV. People are still going to look at free and easy entertainment when things are bad, and TV will do okay. They're not going to do amazing. Maybe streaming growth will slow down, but their linear TV advertising affiliate licensing business will provide that cash flow to get them through it. They can potentially buy back stock. That's one thing I'm wondering why they haven't done that yet. Your stock is relatively cheap. Announce a share buyback. You've recently sold Simon & Schuster. You've recently sold some real estate. You have a bunch of cash. Yes, you are certainly using it to pay down debt. But if your debt rates aren't that high, buy back some stock as well. The prices are certainly interesting at this level from a valuation perspective. Again, focus here is on streaming. We already talked about that. Issue here, is their content any good? What the hell? Clifford the Big Red Dog, certainly not going to compete with Disney Plus. Some decent show, Mayor of Kingstown, 1883, which is a split from Yellowstone, like a sideshow to Yellowstone, so people are going to watch that. Some South Park specials, live events in the NFL. Paramount Plus is growing. It seems like it includes local sports such as the A-League in Australia. Don't know what that is. Showtime with Dexter and the New Bloods and Yellow Jackets. Again, this is very much a content game. Are they going to be able to produce stuff that people want to watch? Is Halo going to be a hit? They've already renewed it for the second season, so they're clearly committed to some of this stuff. They talked about, hey, by 2024, by 2025, we're going to have South Park back. We're going to have other stuff back. We're going to have Yellowstone back. So they're clearly trying to put as much of their own content on this stuff as possible. I think that's going to hit some of their licensing revenue, which is a high margin business. It's going to put pressure on their bottom line. I don't think it's going to put pressure on their top line, obviously, but their bottom line is going to be hit as they're kind of transferring some of that revenue from potentially licensing and other into, or affiliate into streaming, which is a lower margin business for now. That could be a problem in the short term. In the long term, the upside here is going to be, hey, streaming has to work. You're putting a lot of your eggs in that basket. You're producing a lot of content. You're probably going to start burning some cash. At the end of the day, I think this is still going to be a cash positive business, which it has to be a successful investment in my mind. Even this year, as they produce some of this content, they did pretty well. I don't think they're guiding for a decrease in cash flow year over year, but I could see this kind of dropping down to flat. At the end of the day, though, they have a pretty decent cash cushion, and the debt isn't ridiculously bad given their EBITDA. So you're talking about, $11 billion in debt, net debt against $4 billion-ish in EBITDA. So maybe slightly below 3x, not too bad. They can pay that down as well with some of the cash. They can produce content. Cable networks are there. Hey, there's Dexter. There's Kevin Costner, a show you don't even have on Paramount Plus. I think, their film entertainment business could use some work. Probably need a new Star Trek movie. I think there's a new Sonic movie coming out. There's a Sonic Knuckles TV show going to Paramount Plus. So content is going to be key. Cash is going to be key, right? They sold the CBS Studio Center and the BlackRock office building. I think they should buy back stock at these prices, especially if these prices continue to be lower. I do think this is an interesting investment at this price point. I think this is one that I will look at very closely. I will probably start a position, especially if it drops a bit more. I've always kind of had this 3%, 3.5% yield. In my mind, if they hit a 3.5% yield, which would be somewhere around $27 or so, is when I would start my position. I do think this can certainly go lower. The market certainly doesn't love what they're doing in terms of streaming and focus on streaming. If you look at what this is going to mean for their bottom line, right? Cash flow last year was $1.9 billion. Cash flow this year is $600 million, so much lower. Clearly, the difference is, hey, we spent an additional $2.2 billion on television programming and feature film content for their TV streaming services are not cheap. So this could be pressured. They are going to have to be flexible in order to achieve that growth. If you look at the spend against Netflix, the spend against Amazon, it's not that much different. But again, a lot of this is television programming. It's not content that's purely meant for Paramount Plus, and maybe that's a good thing, right? In the long run, if they produce content for CBS that people like, they can put it on Paramount Plus. No additional cost, but additional earnings over the lifetime of that content. So I do think there's going to be content produced directly for Paramount Plus, but also a lot of content that just moves from CBS, from Nickelodeon, etc. I do think eventually Showtime and Paramount Plus will somehow merge. I do think there's potential for Viacom to just be bought out by somebody. Valuation here is interesting. You could take on something that is already generating a lot of cash, put it on your own streaming services, put a lot of content onto your streaming services. I think the only issue is that this linear model is not something that a lot of these streamers want, right? They just want the content. So Netflix is probably not going to buy them out. Apple is probably not going to buy them out. They don't want to deal with linear content. Could a Comcast Viacom merger happen? Probably, if the government allows it. Probably some other mergers could be out there. You've already seen Warner rather, and Discovery merging. Is there another potential merger here with Viacom and Comcast? Potentially. I think they could certainly strengthen their services. But even if they don't, I think this is a business that could be an interesting valuation at today's prices, and one that I'm certainly going to probably invest in if I could get in, maybe a couple bucks lower than it is today. And even at today's prices, I might just start a small position and continue to nibble down if it falls. So let me know what you guys think about Viacom. Interesting model here, interesting business, linear TV floating down into direct to consumer. I think they're making the right move. The market certainly doesn't like it. They're going to spend a lot of money to make that happen. Short-term earnings, short-term cash flow is going to be pressured. But if they can get out to 24, 25 with 100 million plus in direct-to-consumer members, if Pluto TV can continue growing, double their monthly average users by 2024, 2025, this could be a really good valuation that could potentially just be their direct-to-consumer business at today's valuation by 2024, 25. And you get all this other stuff, all of this linear TV, all of this stuff that actually makes money basically for free by then. So something to look into, something to consider. Remember, guys, not a qualified financial advisor, just looking into this for fun. Please do your own due diligence before you make any investments. But let me know what you think. Let me know what you think about Viacom, if any of what I said is off, or if you disagree, or if you agree, if you're a buyer at this price point, and if you think it's going up from here, or if you think it's going lower. So thanks for watching. Let me know what you guys think, and have a good rest of your day.